Microsoft stock has been on an absolute tear lately, and you've probably seen the headlines. But is it running on solid ground, or is it getting a little ahead of itself? Today, we're going to pop the hood and do a full technical health check, based on a professional analysis. We're going to look past the hype and see what the charts are really telling us. Let's get into it.
So on the surface, everything looks amazing, right? The price just keeps going up. But, the number you see on the news is rarely the whole story. Is this trend really built to last? Or are there some warning signs hiding just beneath the surface? Well, that's exactly what we're here to figure out.
All right, first, let's lock in one very important number, $528.57. That was Microsoft's closing price on October 6th. For this entire breakdown, every chart, every indicator we look at, it's all going to be based on this specific number. This is our ground zero.
Now, before we get into the nitty-gritty, let's zoom out. You've got to know where a stock has been to have any clue where it might be going. So let's trace its journey over the last 3 months and see what that story tells us.
So as you can see, it's a pretty clear upward path. We start around 503 back in July and climb all the way up to where we are now. But here's the really crucial detail. It's not just about the price. Look at those big green days, like July 31st and September 19th. They happened on massive trading volume. You can think of that as a huge vote of confidence from the market. It means a ton of investors were piling in, and that gives this whole uptrend some serious credibility.
Okay, so the overall trend looks healthy. Now it's time to get out the diagnostic tools. Let's look at the specific technical indicators that are flashing green. The signals that are telling analysts that the stock's internal engine is running strong.
And before we jump into that data, let's quickly talk about a key tool here, the moving average. Just think of it as the stock's performance baseline. It kind of smooths out all the day-to-day noise so you can see the real trend. If the current price is above that baseline, it's kind of like a runner who's way ahead of their average pace. It's a very positive sign.
And wow, look at this. The current price isn't just above one moving average, it's floating above all of them. And that is a huge deal. It means short-term traders, medium-term investors, and long-term holders are all seeing the exact same thing, strength. This tells us it's not just a quick little surge, it's a sign of a really broad, healthy agreement in the market.
And it doesn't stop there. Other tools in the kit are all pointing in the same direction. The MACD, which measures momentum, is showing that this upward push is actually picking up speed. The Arun oscillator, which is basically a trend strength meter, is pegged high. And maybe most importantly, the Chaikin oscillator shows that money is actively flowing into the stock. Fresh cash is coming off the sidelines to buy shares.
Okay, so everything looks perfect, right? Case closed? Well, this is where the story gets a little more interesting. You know how a car engine can run in the red? A stock can do the same thing. It can get too hot, too fast. We call this being overbought. And some of our other instruments are starting to flash some pretty serious warning lights.
And this is where you can see that conflict perfectly. On the left, you've got all those great signs of a strong trend we just talked about. But on the right, you see the warnings. The RSI and Williams R are gauges that basically tell us if a stock has gone up too far, too fast, and both of them are in the danger zone. And see how the price is above the upper Bollinger Band? Think of those bands like a normal trading channel. Pushing above the top is like stretching a rubber band to its absolute limit, and you know what usually happens next. A snapback becomes a lot more likely.
And this quote from the analysis just hits the nail on the head. A linear regression trend is really just a fancy way of saying a stock's own historical track record. So what this is saying is that Microsoft's price has shot up so fast, it's now way above where its own history would predict it should be. It's gotten ahead of itself. So we have this powerful trend fighting against some pretty serious overheating warnings. And that brings us to the current battleground. Right now, analysts are watching two key price levels, a floor and a ceiling, that are probably going to decide the stock's next big move.
First up, we have the floor. In trading terms, this is called support, and it's right around $511. Now, that's not some random number. It lines up perfectly with the 20-day moving average we talked about earlier. The idea here is that if the price does dip, buyers who've been waiting for a sale will probably jump in right here and support the price, keeping it from falling much further.
And if 511 is the floor, then think of 531 as the ceiling. This is what we call resistance, and it's right at the stock's recent high. This is more of a psychological barrier, where people who bought lower might start thinking, hey, maybe it's time to sell and take my profits. All that selling can create a ceiling that's really tough to break through.
Now, you shouldn't expect the fight between this floor and ceiling to be a quiet one.
An indicator that measures daily volatility is sitting around $8. That means lately, Microsoft stock has been swinging by about $8 a day, on average. That's a pretty wide range, and it tells us the battle between 511 and 531 is likely to be very active.
Okay, so we have the long-term strength, we have the short-term warnings, and we have the key price levels for the battleground. So, how do we put all these pieces together? Let's get to the analyst's final take and the possible ways this could all play out.
So when you boil it all down, there are really three main paths forward. First, the bullish path. The buyers are just too strong, and the stock smashes right through that 531 ceiling and keeps climbing. Then there's the neutral path. The buyers and sellers kind of fight to a draw, and the stock just gets stuck, bouncing between the 511 floor and the 531 ceiling for a while. And finally, the bearish path. Those overheating signals went out, sellers take control, and the stock pulls back toward that 511 floor.
So what's the bottom line here? Well, the big picture trend is undeniably strong, no question. But in the short term, that engine's running hot, and the stock is definitely in what we call slightly overbought territory. Because of that tension, a small pullback or even just some sideways trading to cool off really wouldn't be surprising at all. In fact, it'd probably be healthy. And that's why the report's final suggestion is that for long-term holders, this might be a logical spot to think about taking at least some profits off the table.
And really, that leaves us with the ultimate question that this whole thing boils down to, doesn't it? When you have a powerful, strong trend slamming into some very clear technical warnings, which one is going to give way first? It's like an unstoppable force meeting an immovable object. And the answer to that question is going to determine Microsoft's next big move. And now, you know exactly what to watch for.